My name is Jemima Kezia Mae Gloria. I'm the second reporter of Chapter 17, which is the management of cash and marketable securities. When it comes to collections process, it's all about speed, right? Get the payments and send them to the processing as quickly as possible. Nearly every organization that deals with the collections has a workflow in place. But is your current workflow serving your organizations?
There are methods available in expediting collections to reduce the collection float. First is the decentralized collection centers and concentration banks. Cash collections system can be either centralized or decentralized. In the centralized system, customers are instructed to send their payments to the firm's headquarters, while decentralized system, customers mail their payments to a nearby collection center which is strategically located to maximize mail delay. In concentration banking, it is the use of decentralized collection centers and local banks to collect customers' payments. However, these savings from faster collections are offset by the direct fees involved, the opportunity cost of the compensating balances the firm must maintain at each local bank or both. The second method is the lockbox collection system. Lockbox is a post office box maintained by a local bank for the purpose of receiving a firm's remittances. Customers mail payments to this post office bank, which is usually no more than a few hundred miles away. The bank empties the box several times each working day, then deposits the payments in the firm's account, put the checks into the clearing system, and send the firms a list of payments received each day. Not only does the lockbox reduce mailing time, but it also eliminates company processing time because the checks are deposited and begin the clearing process before the company's accounting department process the payments received rather than after processing them. The third method is wire transfers and depository transfer checks. Wire transfer funds are sent from a local bank to a concentration bank electronically through the Federal Reserve System or a private bank wire system. Wire transfers are the fastest way of moving funds between the banks because the transfer it only takes a few minutes and the funds become immediately available. While depository transfer check or DTC is an unsigned non-negotiable check drawn on the local collection bank and payable to the concentration bank. If you have DTC, you also have EDTC or an electronic depository transfer check. It can also be used to move funds from a local bank to a concentration bank. This system eliminates the mail float in moving funds from the local bank to a concentration bank. Funds that transferred through an automated system are available for the use by the firm in 1 day or less. And the fourth method is the special handling of large remittances. The firms that receive the individual remittances in the multi-million-dollar range may find it more profitable to use special courier services to pick up these checks from the customers. And the fifth method is the use of pre-authorized checks or PAC. It resembles an ordinary check except that it does not require the signature of the person or a firm on whose account it is being drawn. This system is especially useful for firms that receive a large volume of payment of a fixed amount each period.
What is slowing disbursements? It is a basic strategy of cash management to delay the payment as long as possible without impairing the credit or rating standing of the firm. In fact, slow disbursement represents a source of funds requiring no interest payments. Like for the example, the company mails the check to the creditors at a certain period of time. Then the creditor's office receives the check. After that, the check need to deposit to the bank for the check clearing period of time, and the company clears the check.
Different ways that can slow disbursements and keep funds in the bank for a longer period of time. First is the scheduling and centralizing payments. A firm should pay bills on time, not before or after they are due. There is no significant benefit to be received by paying bills before they are actually due, unless a cash discount is offered for early payment. Centralizing payments from disbursement accounts maintained at concentration banks helps minimize the amount of the idle funds a firm must keep in a local field offices and division bank account. Second is the drafts. A draft is similar to a check except that it is not payable on demand. Instead, when a draft is transmitted to a firm's bank for collection, the bank must present the draft to the firm for acceptance before making payment. Third is to maximize check clearing float. Checks are issued from the account most distant from the payee. Some firms make payments to suppliers from checking accounts located a long distance from the supplier. For example, an East Coast supplier might be paid with checks drawn on a West Coast bank. This increases the time required for the check to clear through the banking system. Some firms maintain an intricate network of disbursing accounts.
What is EFT or electronic fund transfer? It is an electronic transfer of money from one bank account to another, either within a single financial institution or across multiple institutions, via computer-based systems without the direct intervention of a bank staff. To put it simply, EFT is what happens when you take money from one bank account and you send it to another without relying on another human being to handle the transactions. Instead, a secured network is playing the role of a bank teller because a world runs on the EFT includes ATM when you withdraw money, e-transfers when you receive money from different individuals, and electronic bill payments when you pay your bills from bank websites. This technology is already present everywhere in our lives. But how can you improve your business operations? EFT is not only a staple of daily operations, it is also a game changer when you can't go home to your office anymore. For example, your head office or your industry in the neighborhood might be temporarily closed. Meanwhile, your accountant is working from their downtown condo or your CFO is working from their house. As your operation still shifts from your distribution center in another city using EFT automates your banking transactions in the cloud without needing physical presence to sign the checks, approve payments, or process funds from your office. You can complete this task remotely wherever your office is.
What is marketable securities? It is an investment that can easily be bought, sold, or traded on public exchanges. The high liquidity of marketable securities makes them very popular among individual and institutional investors. These types of investment can be debt securities or equity securities. Rather than let your cash reserves build up in excess of daily cash requirements, many firms invest in interest-bearing short-term marketable securities. On determining the level of liquid assets that can be showed or invested in marketable securities, it have different several factors, which is the interest to be earned over the expected holding period, the transaction cost involved in buying and selling the securities, and the variability of the firm's cash flows. A firm may choose among many different types of securities when deciding where to invest excess cash reserves. In determining which securities to include in its portfolio, the firm should consider the number of criteria. The default risk. Most firms invest only in marketable securities that have little or no default risk. The risk that a borrower will fail to make interest and or principal payments on a loan. Second is the marketability. A firm usually buys marketable securities that can be sold or short notice without a significant price concession. Thus, there are two dimensions to a security marketability: the time required to sell the security and the price realized from the sale relative to the last quoted price. The next characteristic is the maturity date. Firms usually limit their marketable securities purchases to issues that have relatively short maturities. This is known as in the interest rate risk. For this reason, most firms generally do not buy marketable securities that have more than 180 to 270 days remaining until maturity, and many firms restrict most of the temporary investment to those maturing in less than 90 days. Because the yields on securities with short maturities are often lower than the yields on securities with longer maturities, a firm has to be willing to sacrifice yield to avoid interest rate risk. The last characteristic is the rate of return. Although the rate of return or yields is also given consideration in selecting securities for inclusion in a firm's portfolio, it is less important than the other criteria just described. The desired invest to securities have the minimum default and interest rate risk, and that are readily marketable usually limits the selection to those having relatively low. To confine the marketable securities investment to money market instruments, those high-grade, low-default risk, short-term debt instruments having original maturities of 1 year or less. Money market instruments that are suitable for inclusion in a firm's marketable securities have different types. First is the U.S. Treasury issues. Second is the other federal agency issues. Third is the municipal securities, negotiable certificates of deposits, commercial paper, repurchase agreements, bankers' acceptance, euro-dollar deposits, auction rate preferred stocks, money market mutual funds, and bank money market account. First type of marketable securities is the U.S. Treasury issues. It is the most popular marketable securities sold weekly auctions through Federal Reserve banks, and their branches have standard maturities of 91 days, 182 days, and 1 year. The advantages of Treasury issues include short maturities, a virtually default-free status, and ready marketability. Their primary advantage lies in the fact that their yields normally are the lowest of any marketable securities. Second types is the other federal agency issues. It is a number of federal government-sponsored agencies issue their own securities, including the Big Five: the Federal Home Loan Bank, the Federal Land Bank, the Federal Intermediate Credit Bank, the Bank of Cooperatives, and the Federal National Mortgage Association. Although each of these agencies guarantees its own securities, these securities do not constitute a legal obligation on the part of the U.S. government. The seventh type of marketable securities is the banker's acceptance.
It is a short-term debt instrument issued by a firm as part of a commercial transaction. These instruments vary in the amount depending on the size of the commercial transactions. The eighth is the euro-dollar deposits. Dollar-denominated deposits in banks or bank branches located outside United States. These deposits usually have slightly higher yields than on corresponding deposits in domestic banks because of the additional risk. The ninth types is the auction rate preferred stocks. A number of large investment banks issue on behalf of their clients. The 10 types is the money market mutual funds. The investment of many other small investors and invest in large denomination money market instruments. In addition, most of these funds offer check writing privileges which provide liquidity and enable firms to earn interest on invested funds until their checks clear. The last type is the bank money market accounts. These accounts provide yields that are comparable to those on money market mutual funds. Banks that are permitted to offer checking accounts with yields comparable to those on money market mutual funds with limited checking writing privilege. The 10 types is the money market mutual funds. The investment of many other small investors and invest in large denomination money market instruments. In addition, most of these funds offer check writing privileges which provide liquidity and enable firms to earn interest on invested funds until their checks clear. The last type is the bank money market accounts. These accounts provide yields that are comparable to those on money market mutual funds. Banks that are permitted to offer checking accounts with yields comparable to those on money market mutual funds with limited checking writing privilege. So, in summary of my report, the primary objective in controlling cash collections is to reduce the delay between the time when the customer mails the payment and when it becomes a collected balance. Methods of reducing collection time include decentralization collection centers and concentration banks, lockboxes, wire transfers, depository transfer checks, special handling of large remittances, and the use of pre-authorized checks. The primary objective in controlling cash disbursement is to slow the payment and keep the firm's funds in the bank as long as possible. Techniques of slowing disbursement include scheduling and centralizing payments, or the zero balance systems, using drafts rather than the checks, maximizing check clearing float, and stretching the payables. EFT, or the electronic fund transfer mechanism, include the use of the wire transfers and automated check clearinghouse. Increasingly, it will reduce the importance of the float management techniques. The primary criteria a firm should use in the selecting marketable securities include the default risk, marketability or liquidity, maturity date, and the rate of return. So that's it for my report. I hope and you understand it. Thank you and stay safe everyone.